China's economy is in crisis and about to hit rock bottom. As shocking as this may sound, it is very true. Today, China's economy is in a deep hole that cannot be filled by increased exports and government support. Over the years, through massive government expenditure, China was able to shoulder the huge recession that affected many parts of the world from 2008 to 2009 and even ended up supporting the world's economy. Today, a repetition of a Chinese-led recovery is less likely since the world is perilously close to entering a global recession due to Russia's conflict in Ukraine and 3 years of the COVID-19 pandemic. But this begs the question of, how did China get here? Who knows? As tragic as it is, this might somehow mark the beginning of China's economic downfall. Last year, despite $3.59 trillion in record-breaking exports and a 7% increase in exports, China's government failed to meet its 5.5% GDP growth goal. The economy only increased by 3% according to official statistics, making it one of the poorest exhibitions in close to 50 years. This is largely due to uncertainty brought on by frequent COVID-19 lockdowns. According to a survey, growth is expected to continue sluggishly in the first quarters of 2023 before picking up significantly in the second half of the year. The group's projections ranged widely between 4.0 and 5.9%, with the average GDP growth estimate coming in at 4.7%. China's downturn has affected its trading partners by lowering demand for imports of items including food, oil, and consumer goods. Global suppliers who face increasing danger of recession in Western economies would benefit from a resurgence. From 3.9% in the prior quarter to 2.9% in the 3 months that ended in December, according to data from the National Bureau of Statistics. After the ruling, Chinese Communist Party unexpectedly abandoned its zero-COVID regulations in December. Consumer spending began to improve, but remained still sluggish. Since Beijing started implementing economic reforms in 1978, China's GDP has increased by an average of around 10% yearly. After the epidemic started, the second largest economy in the world experienced many ups and downs. Repeated crackdowns on the private sector and tight zero-COVID lockdowns have destabilized supply chains and eroded investor confidence after early optimism about the economy's recovery in 2020. Above all, the country's population fell last year for the first time in 60 years, generating unsettling concerns about its future labor force. After reaching a peak of 14.2% in 2007, China's economic growth has been in a long-term downturn as a result of obstacles such as aging, a declining labor force, and expanding security-related restrictions on Chinese access to Western technology. According to official data released on Tuesday, the number of people in China between the ages of 16 and 59 who are working has decreased by nearly 5% since its 2011 peak. As a percentage of the 1.4 billion people, the working age group has decreased from 70% to 62% over the past 10 years. Economic growth is anticipated to be limited to around 4% for the remainder of the decade, according to projections from the International Monetary Fund and the private sector. Retail sales fell at a rate of 1.8% in December compared to the same month last year, which was an improvement after the 5.9% decline experienced in November. Due to a rise in COVID-19 infections that have caused hospitals to become overrun with patients, wary shoppers are only gradually returning to restaurants and shopping centers. After contracting by 0.5% in November, investment in factories, real estate, and other fixed assets recovered to expand by 0.5% in December. This year, growth is anticipated to increase to a still modest level of roughly 5%. Slowing exports and weakening in real estate, a key economic driver, are cited by economists. The increase in factory output in 2022 from the previous year was 3.6%, indicating that activity slowed after reaching a peak of 4.8% in the third quarter of the year as U.S. and European demand for Chinese goods slowed under the weight of interest rate hikes intended to curb record-breaking inflation. Following a pledge by the CCP in November to lessen the cost and disruptions of zero-COVID, some of the most widespread antivirus measures in the world were abruptly discontinued. Every sick person was to be isolated under such a policy. It aided in keeping China's infection rates lower than those of the majority of other nations. To combat breakouts, it closed down Shanghai and other cities for as long as 2 months at the beginning of 2020, which affected both trade and industry. From April to June, growth hit a low of 0.4% compared to a year earlier before picking up in the third quarter to reach 3.9%. Authorities reimposed restrictions that forced the closure of factories and forced millions of people to stay at home in response to a fresh illness wave that started in October. Protests broke out in Shanghai and other places as a result of widespread public annoyance. Some demonstrators in Shanghai demanded the resignation of Chinese President Xi Jinping. The ruling party released rules that prevented the majority of movement into and out of China by eliminating quarantine, testing, and other limitations. It has not yet been indicated when mass tourism would start again in the nation. Even after those restrictions were loosened, the lack of personnel who weren't affected led some companies and eateries to close for extended periods in December. The ruling party has reversed course on important financial and industrial measures in order to support the economy, dialing down anti-monopoly and data crackdowns intended to tighten control over China's digital industries. On global stock markets, the campaign caused the share prices of internet companies and e-commerce behemoth Alibaba to drop by hundreds of billions of dollars. Additionally, the government is placing restrictions on real estate financing following a decline in economic growth beginning in 2021 as a result of tougher regulations on debt, which Chinese policymakers fear is dangerously excessive. In essence, the plan is to create a domestic consumption-driven economy to diminish China's dependence on export-driven growth. A strong domestic market can serve as a shock absorber for sanctions from the West and a fragile international trading system. In addition to pursuing cutting-edge technologies like quantum computing and improved semiconductors, China's new plan intends to lessen the country's carbon imprint. The need for domestic development of these technologies has increased as a result of a wave of stringent export control measures implemented by the U.S. with the intention of destroying China's chip sector. This month, the World Bank lowered its prediction for China's economic development in 2023 from 5.2% to 4.3%. It highlighted COVID-19 uncertainties and the struggling real estate sector. Smaller developers in an industry that contributes up to 25% of China's economic activity were put out of business by the debt crackdown. Some of the most powerful rivals missed bond payments. While anxious customers awaited information on developers, sales plummeted. The world's most indebted firm, Evergrande Group, which is attempting to restructure more than $300 billion in debt owing to banks and bondholders, has financial markets waiting to see what will happen. On the other hand, economists predict that China's growth rate would fall between 2 and 5% during the next few years. As a matter of fact, that itself conceals a transition that is underway. GDP metrics only provide a fragmented, time-delayed picture of the Chinese economy. Thus, concentrating on them runs the danger of missing the forest for the trees. China's current record-breaking growth is fueled by exceptional demographic and economic circumstances. But those circumstances have already vanished. As China's population ages quickly, the large labor pools that supported its low-cost industrial base are getting smaller. In 2022, the population of the nation began to drop after several years of slower birth rates. This year, India will surpass China in terms of population, while multinational corporations continue to relocate more production to countries in Asia, including Vietnam, Malaysia, India, and Bangladesh. The debt-fueled infrastructure and real estate developments that have formerly fueled China's growth have also reached their peak. China's total factor productivity, which measures how much output an economy actually produces as a percentage of inputs, is no longer increasing at the same rate as it once did. Before 2008, productivity growth was 2.8% on average, but since then, it has fallen to barely 0.7% annually. In the end, the decline in demand will be felt strongly in many nations, especially those who have come to rely heavily on China as their main export market. The winners and losers in this shift will largely depend on how quickly countries can switch to other emerging markets with stronger growth rates, such as those in Southeast Asia and India. The balance of power in geopolitics will also be affected by the recession. If China reaches its economic peak in the following years, it is less likely that it will overtake the U.S. as the world's most powerful country. But with China finally transitioning out of zero COVID, can it ever hope to return to sustained high growth? And in the long run, do you think China's period of rapid growth is over? We'd love to know your thoughts in the comments section. If you enjoyed this video, make sure you click the like and subscribe buttons. Most importantly, don't forget to click the bell icons to be notified when a new video is uploaded. Also, feel free to leave a remark if you have any recommendations for videos. Have a great day, everyone, and thanks once again.